Hi friend, welcome to my channel. Today I thought I'd talk to you about investing in the stock market and the things you need to do before investing in the stock market. Now I've invested for the last couple of years in the stock market, but I've researched the hell out of investing for many more years before that. And I believe in very low risk, low time input investments, and it's still done me very well over the last couple of years. It's averaging between 20 and 25% returns. So today I wanted to share with you the 5 things that you need to do before you get to the sexy bit of investing. The first thing that we need to do is to embrace risk. Now that word does have a lot of negativity to it, but unless you embrace the risk and value the risk and manage your risk, you will lose money in the stock market. eToro, the website, one of the trading websites, they say that 75% of people investing in the stock market lose their money. There's only 25% of people who gain money in the stock market. So if you want to be in the 25% of the people, you need to embrace risk, but understand and manage your risk. And the main thing you can do to manage your risk is to see when you need access to this money. If you need access to the money in the next 3 years, do not invest that money in the stock market. If you need money within, say, 3 to 5 or 6 years, expose that money to medium volatility. And any money you need past that, you can maximize to the volatility that you expose that money to. So, like I told you in a previous video, try and have money buckets so you know this is a short-term goal, so I need to balance the risk that way. This is a medium-term goal, so I need to manage the money that way. And this is a long-term goal, so that I can expose it to the maximum risk. I'll briefly show you with a working example of a life strategy fund, and this is from Vanguard. It's an investment platform, but you can find similar funds across all other platforms. So using the life strategy funds from Vanguard, there is different equity ratios and if different bond ratios. Equity is all stocks and no bonds, which sort of manage the risk, and the more bonds that you add, the lower risk the money has, but less the returns. So if you have any money that you have a long-term plan for, so for me that is my pension money, for me that is my younger daughter's education money, for me that is a little money that I'm saving towards overpaying my mortgage money. So these are my long-term goals. So that I've put in the Life Strategy 100 funds, which is all equity and no bonds. Similarly, any money that you need medium term, so say within the next 3 to 6 or 7 years, you expose it to medium volatility. So for that, you may want to use the Life Strategy 60 or the Life Strategy 80 funds, which is only 60 or 80% equity, but there is buffer the volatility and buffer the risk, and that's how you manage your money. And any money that you need within 3 years, keep it in cash. So just to sum that up very briefly, over the short or the medium term, the markets can be very volatile, but over the long term, the markets always go up in value. So you're just depending on the market growing up in value over time. So you manage your money and the time you need access to that money, and the risk will take care of itself. The second thing that we all can do is to KISS. It's an acronym for keeping it simple and stupid. So if you're half interested in the stock market, you're probably listening to the news and listening to all these things that's going up in value, and the thing that you're missing out on, the FOMO, the fear of missing out. So Tesla is going through the roof as we speak. A few weeks ago, Bitcoin was going over the roof, but then it crashed big time as well. Just yesterday, GameStop, a company, has just gone over the roof as well. So we all listen to news like this and we feel that we are missing out on all this growth. But back in 2008, Warren Buffett, if I'm into investing, you've probably definitely heard of Warren Buffett. He is the guru of investing. Everyone listens to what he has to say. So back in 2008, Warren Buffett had a challenge for hedge fund managers and money management managers. So these are very intelligent people who have degrees in investment banking and have a team of people working under them. So he gave them a challenge that over the next 10 years till 2018, if anybody can successfully beat the market for 10 consecutive years compared to the S&P 500 index, he'd give them some X amount of cash prize. And nobody successfully managed to do that. So generally, if you try and pick stocks and try and beat the market, you will get it right 50% of the times, but you will definitely get it wrong as well 50% of the times. So the best thing to do is to invest in a globally well diversified index fund and let the market do its job of growing up in value over time. And what you can do is manage your risk by timing your money. But if you still feel that you're missing out, I feel that I'm missing out. If fear of missing out is a real thing, isn't it? So if you feel that you're missing out, what you can do is have your core portfolio, which should be 80-85% of your savings, in a globally diversified fund, and have, say, 15 to 20% of satellite funds, which can be anything that you fancy or that you believe might go up in value. This way, you're doing the best of both worlds. You're managing a globally diversified portfolio that will go up in value over time, and you're also trying your luck with other things that you believe might go up in value in the short term. So you're getting the best of both worlds by managing a core portfolio and some satellite investments. The third thing that we all can do is to manage our tax as we are building up wealth. There's two main tax wrappers in the UK. There is your pension, which is a pre-tax wrapper, and there is the ISA, which is a post-tax wrapper, and both can be used simultaneously to manage your tax over time. And there is similar tax wrappers in any modern Western economy, be it America, be it Canada, be it Australia. So all major Western economies where you pay your tax, or in Europe, there is different tax wrappers, similar tax wrappers, where it's pre-tax money and post-tax money. So have a little bit of understanding of how these tax wrappers work. You can invest in your pension, and most of us have an employer pension, and the employer contributes, so there's a lot of free money going into your pension, but you can have access to this money only at pensionable age. You can also have your own SIP, which is your self-invested personal pension, which your pre-tax money goes into. So for every £1,000 that goes into your pension, let's just forget about the employer's contribution bit for now, but for every £1,000 that you pay into your pension, be it your employer's pension or a private pension, £1,000, if you're a basic rate taxpayer, costs you only £800. And if you're a higher rate taxpayer, it costs you only about £600 for £1,000 being invested. So you have a lot more money going into your pension. So the money that grows into your pension grows faster because there's no more money in your pension. But when it comes to withdrawal, you pay tax on that money. So most people, they manage their money by investing some into pension and some into the ISA. With the ISA, £1,000 invested into an ISA as a basic rate taxpayer, it's costing you around £1,200, and as a higher rate taxpayer, it's costing you about £1,400. So there's less money going into an ISA, but the big advantage is it's tax-free on withdrawal. So invest in a little bit of both, so you pay minimum tax today and when you're withdrawing in the future. To manage your tax wrappers a little bit more, what you can do is you can invest under your spouse's name, provided you trust them with your money, of course. So this way you're using both people's tax allowances, so you're managing your tax affairs a little bit better. The fourth thing that we can do is to find out our disposable income or our residual income. So this is the money that we earn minus the money that we spent, and the remaining money that we have after all our expenses is our disposable income. So to make your disposable income bigger, what you can do is increase your wages. So this can be done by getting a part-time job, upskilling yourself so you get a better salary package. It can be using credit cards and cashbacks from financial institutes to get more money back into your back pocket. To decrease your expenses, make sure you're not overpaying for your broadband or your TV package or your electricity or your telephone bill. Make sure you're managing your grocery bills as efficiently as you can. So ideally increase your income as well as working on decreasing your expenses to get the biggest possible disposable income, and this is the money that you can use to invest. So get the biggest possible disposable income. The last thing that we all need to do when investing is to review your portfolio annually. So every year, just pick a day, any year. It can be your birthday, it can be your child's birthday, it can be your spouse's birthday, it can be when you're quiet between Christmas and New Year, it can be any time. So find a time of the year and stick to that time, roughly around that time every year, and review your portfolio annually. So you're mainly looking at your time frames. Has your goals changed that you need the money for? And then adjusting your portfolio and adjusting your risk accordingly. So to summarize and to give you some actionable steps, first is to find out the risk you want to expose your money to, and this is mainly to do with time frames, but there is a few more subtle other factors, and I'll cover about risk in another video. So once you've decided the amount of risk you want to allocate your money to, this helps you decide about the tax wrapper that you want to choose. If it's a long-term goal, you may want to put it in your pension. If it's a short-term goal, you can put it in your ISA. You then choose the fund that you invest in, and this again mainly depends on your time frames. So as you can see, managing your risk and determining your risk at the onset is the most crucial point when it comes to investing, because that determines the tax wrapper that you choose, that determines the fund that you choose. You can have the exact same funds in your pension and your ISA, but the main thing is managing your risk. So I hope today's video has given you some inspiration of things that you need to do before you invest your money. If you have any questions, or if you want me to go into any more detail on any of the topics that I've discussed, let me know in the description box, in the comment section below. If you've liked this video, or if it's helped you in any way, please give me the thumbs up, like button, and share this with your family and friends. And before you go, you may want to check out these other videos relating to investing in things. Thank you for watching me today. Stay safe. Bye-bye.